reading into the jobs report? Are we reading into the tariff increase right now? What's the market moving on?
Yeah, I think it's definitely the tariff side. I think it was important that the job numbers this morning were healthy. If you had a big miss, then that would have been a bigger concern, especially with the loss of momentum. But it's all about trade right now. The other thing is, we've had a great start to the year. This is the best start, first 7 months of the year since 1997. And we were thinking going into August that it was going to be a choppier market. The seasonal trends are a bit weaker. And now we have the whole period of August where there's going to be uncertainty on the tariffs, and we don't have the next Fed meeting until mid-September. That said, we still think that equities over the next 12 months is the place to be.
Terry, what is this escalation going to look like? Do you expect the rates to go higher? Do you expect China to retaliate? Do you expect the 10% to go into effect at all before September 1st?
What I expect,
September 1st.
Well, what I expect, Sarah, is after an expression of seriousness by the president yesterday, some sort of threatened proportional response by the Chinese, and we've seen a lot of this before. And then I think the United States is going to look to see if China will actually start to make some movement on the things that the United States cares about. The president put a lot of this out there yesterday. The president talked about initial moves on agriculture, which hadn't been resolved, following through on promises to stop manufacturing fentanyl. And fundamentally, what the United States remains frustrated by, and I'm not here as a cheerleader for the government, but remains frustrated by is the Chinese lack of willingness to come to an enforceable agreement. In my view, the linchpin of all this has been and continues to be enforceability. If the Chinese will agree to have an enforceable deal, I think they'll find the United States wanting to put a deal in place fairly quickly. Without that, though, what we're going to have, and I think what's likely, is that the current trade war continues into 2020, ramped up a little bit more as a result of the president's actions and the Chinese response.
Terry, we can barely put together an ag purchase. I'm not sure. What's it going to take to get as far as you're talking?
That depends entirely on the President Xi and the meetings of the Politburo over the next couple of weeks when they take their annual retreat. I think another of the frustrations of the United States government has been that, and you can see this in the Chinese official press and the financial press, is the belief that they can wait out the current United States position and that their economy is sufficiently good to be able to do that. I think what the president's trying to do here is, frankly, push them to get down to the table, get serious, and get a deal done. I think we see that in terms of timeline. I think we see that in the next 2 to 3 weeks, whether they're willing to actually do that. And as was pointed out a few minutes ago, I think that if the Chinese make some goodwill gestures to do the things they'd already said they were going to do, I think you'll find the president interested in wanting to not only to continue negotiations, which he said yesterday, but also maybe to hold the tariffs off a little bit in order to facilitate the next meetings in September.
Meanwhile, Keith, on levels, people have been watching 2950 as a marker that would determine whether or not we had a false breakout like last September. At least that's the word from technicians. Are you worried about where we are right now?
No, not broadly. I still think that the downside is probably limited to about 5 to 7%. As far as sentiment got a little bit hot short term, but the fund flows this year and over the last 12 months have been hugely negative. That's not consistent with a major top. The other thing is to think about now. We have this 10-year Treasury at 1.85%. We now have 50% of the S&P 500 names with dividend yields above the Treasury. So that should provide some support for the market as well. And, we have to just get used to this ongoing carousel of concerns that we've been dealing with the last few years. And, if people sell based on these tariff news, you have to just remember we just made a new high in the market last week. And we do expect some digestion, some back and forth. But later in the year, we do expect to make new highs.
Very quickly, Keith, the declines are sharper overseas. In Europe right now, it's a sea of red, more than 2% declines across the major averages. Hong Kong down 2% overnight, Japan down 2% overnight. Is this continued playbook of the U.S. can weather this the best, and so U.S. equities are the best place to be?
We still think the U.S. is the best place to be, some of which you're seeing overseas is just a catch-up of the sell-off late yesterday. But I mean, as we've seen today, the U.S. economy is still solid. Employment is still solid. Wage growth is moving up. The consumer is 70% of the economy. One thing that's missed is that the savings rate now for the consumer is at 8%. That's about triple what it was heading into the 2000-2008 recession. So again, yes, we think the U.S., the earning trends are better, and we think that is the best place to still be going forward.